People have been checking out different ways to make some cash. Some are looking at bonds for a steady income, but guess what? Traditional dividend stocks are back in the spotlight. Bond yields are rising around 5%, but stocks with an extra 3 to 4% in dividends are stealing the show. Why? Because stocks have this cool potential for price growth that bonds can't match. The big question is, which stocks are your best buds for long-term financial safety? In this video, we've got the lowdown on the top 8 stocks, straight from Charlie Munger's stash. Before diving into that, subscribe to our channel, Financial Freedom, and press the bell icon to stay in touch. Also, watch the video till the end for a bonus gift. Let's start with the number 1 stock, Kellnova. Kellnova makes a name for herself in the volatile stock market by profiting from the rising popularity of snack foods. Kellnova, originally a subsidiary of the well-known Kellogg's and then rebranded as WK Kellogg, has carefully held onto control of high-growth, high-margin snack products like Eggo and Pringles. Concurrently, WK Kellogg steers its trajectory by depending on slower-moving cereal brands such as Raisin Bran, Mini Wheats, and Corn Flakes. Kellnova compares successful businesses such as Mondelez International, a great example in the snack market, and her own. After splitting from Kraft, Mondelez, known for products like Ritz and Triscuits, carved out a place for itself and has prospered despite inflation because people's appetite for snacks is still strong. The early triumphs of Kellnova are evident, showcasing robust sales and earnings growth. Despite a temporary dip of 13.2% in year-to-date EPS attributed to separation costs, the second quarter witnessed an impressive 8% jump post-separation, affirming sustained profitability. Positioning itself as a compelling investment, K stands out as a promising dividend stock, boasting a noteworthy 4.85% yield, a substantial figure, especially when coupled with its overall growth trajectory. As investors navigate the market, Kellnova shines as an intriguing contender with a blend of resilience, strategic positioning, and the promise of fruitful returns. AbbVie. AbbVie has overcome a typical challenge that frequently befalls pharmaceutical businesses, going from a hazardous investment to a dividend stock in the industry leader. Even if Humira's decrease presents difficulties, AbbVie has broken with industry conventions by skillfully substituting solid sales of new medications for declining revenues. There is more to this success story for AbbVie. Even in the face of industry headwinds, the company continues to thrive and provides stockholders with a stable dividend income stream that has been in place since the legendary year 1972. Even with obstacles in its way, AbbVie is still moving forward. Even though second quarter revenues fell 5% to $13.87 billion, they show how resilient the corporation is. Realty income. Realty income recently marked its remarkable 640th consecutive monthly dividend payout on October 10th, underscoring its unwavering commitment to shareholders. This uninterrupted dividend growth, flourishing since 1999, offers an enticing yield of over 6%. Beyond the appealing dividends, O shares are projected to climb approximately 15 from their current 50 value, adding another layer of attractiveness to this perennial dividend stock. While realty income operates in the realm of real estate investment trusts, a sector that may raise eyebrows due to the current volatility in commercial real estate, it distinguishes itself by primarily leasing to convenience stores and pharmacies. This strategic focus insulates it from the heightened risks associated with sectors like office space. As a dividend aristocrat with 25 years of consecutive dividend growth, realty income assures investors of its financial fortitude. Moreover, its penchant for long-term leasing agreements enhances stability by providing a solid foundation for financial projections over an extended period, mitigating uncertainties and solidifying its position as a resilient investment choice. Devon Energy. Devon Energy is a potentially high-risk, high-reward investment within Dividend stocks. As an American exploration and production oil company, it carries a notable beta of 2.33, indicating substantial volatility that, interestingly, can pave the way for significant gains. At the heart of Devon Energy's appeal is its innovative base plus variable dividend structure, a unique feature we'll delve into shortly. Before that, let's explore the driving forces behind the potential appreciation of its stock price. The resurgence of energy prices and escalating tensions in the Middle East, particularly between Israel and Palestine, amplifies volatility in the region. While posing threats to oil supplies, this volatility presents a strategic opportunity for Devon Energy to capitalize on evolving market dynamics. NextEra Energy, the utilities industry mainstay. NextEra Energy has lately seen some volatility in the performance of its shares. The spike in bond rates, which hit levels not seen since 2007, temporarily lessened the appeal of utility stocks, valued for their steady, low-risk dividend income from modest yields. Investors have always been drawn to utilities because they offer consistent, almost risk-free 2% returns. But this allure was undermined when risk-free Treasury bonds started to yield 5%. Despite recent market fluctuations, NextEra Energy exhibits robust growth, complemented by an additional 3.4% dividend yield. Pfizer. Pfizer finds itself at a juncture reminiscent of AbbVie, navigating the challenges posed by a fading blockbuster, Comirnaty, the wildly successful COVID-19 vaccine. While recent stock performance reflects this transitional phase, caution against hasty judgments based on 2021 and 2022 results is advised. Comirnaty's unprecedented success propelled Pfizer's revenues from $41 billion in 2020 to $81 billion in 2021, surpassing $100 billion in 2022. Anticipated 2023 revenues of $66 billion signal a calculated shift rather than a decline, positioning Pfizer for sustained growth. Microsoft. Often overlooked in discussions on dividend stocks, Microsoft quietly rewards investors with an approaching 1% dividend yield. Surprisingly, this yield has surged by over 10% in the last 5 years, adding a lucrative dimension for those drawn to Microsoft's growth potential. In 2023, Microsoft's prowess in the generative AI realm, fueled by substantial investments in OpenAI and ChatGPT, positions it as a frontrunner. However, a potential hurdle arises as the IRS pursues Microsoft for back taxes, with a precedent set by Coca-Cola's ongoing appeal against a 20-20 decision, despite potential tax liabilities exceeding $30 billion. Microsoft's payment timeline remains uncertain, offering a reprieve until the legal landscape stabilizes. VBTX, a pharmaceutical company called Viatris, shows up as a very attractive investment choice for people looking for consistent returns with low risk. While generic medication manufacturers might not have the same glitz as tech businesses, Viatris is unquestionably revolutionary. Viatris, separated from Pfizer less than 3 years ago, boasts a 4.5% dividend yield, surpassing the market average. With a stock that won't break the bank, Viatris provides a blend of high rewards and low risks, making it an attractive investment option. Bonus Ares Capital, a financing company that specializes in lending to middle-market companies with annual revenue between $1 and $250 million, is our bonus company on the radar. On the other hand, possible economic downturns, inflation, and fluctuating interest rates are lessened by careful risk management, diversification across multiple industry sectors, and prioritizing secured loans. Here's a question for savvy investors. Which dividend stock caught your eye and why? Drop your thoughts in the comment box below. Don't forget to subscribe to our channel, Financial Freedom, hit the bell icon for video updates, and share the wisdom with a like and share.